Welcome back for another report on the gold market. Gold's price fell substantially in the past 4 consecutive daily sessions, yet regained some ground on Tuesday's early European morning. Until the past Wednesday, the 6th of January, when the drop started, gold was in a continuous upward trend since late November. Thus, in our view, the latest drop deserves a more in-depth investigation in order to find out the reasons behind traders' choice to cut positions short. We plan to keep this report simple on both fronts, our technical and fundamental analysis, giving all our viewers the chance to comprehend gold-related information. First of all, there is a sudden change of economic sentiment and confidence in the US. Market participants and analysts, along with many US Fed officials, believe the economy is on its way to recovery. This opinion, in our personal view, has not been based on solid evidence that the US economy is rebounding, but rather on expectations that recovery will prevail. Economic data from the US released in the previous week provided mixed signals according to figures. In more detail, economic data like the US ISM manufacturing and the US ISM services PMIs, both for December, saw improved numbers surpassing the previous month. On the contrary, the US employment report for December indicated the jobs created fell by minus 140,000, leaving the unemployment rate unchanged at 6.7%. The employment figures represent 10.7 million people still unemployed, according to the US Bureau of Labor and Statistics. So in our opinion, recovery for the US economy still has a long way to go for the employment market to fully recover to levels seen before the pandemic outbreak. Also, we do not have solid evidence that the pandemic is coming to an end yet, as new cases globally seem to persist. However, despite our personal view, the positivity from the supposed economic recovery in the US has brought to the surface reports by Reuters claiming the US Federal Reserve could be planning to raise interest rates in 2023. The note energizes traders and possibly the sellers for gold's price. Furthermore, Fed officials like Robert Kaplan and Richard Clarida have also made hints that the Fed may keep its approach to overcome the economic damage suffered by the virus steady. This can be translated as the economy does not require the aggressive stance used by the Fed previously and is now willing to keep it stable. In other words, economic circumstances seem slightly better for the time being. As gold traders see Fed officials like the ones pre-mentioned forecasting that the economy could be in better shape in the next months or so, economic risk, which usually motivates traders to purchase gold, seems to weaken, keeping all things constant. On a separate note, as the Democrats have taken control of both Congress and the White House, government spending is expected to rise significantly, with many analysts viewing this as an acceleration of economic recovery. The Federal Reserve may be basing its expectations of a swifter recovery on this awaited enlarged government spending and could even make its own changes. On the contrary, we could see the USD weakening on headlines of a new stimulus package, depending on the size of it. This could ultimately push gold's price higher. As a conclusion, at the moment, the deadly riot that took place last week outside the US Capitol and the possibility of another one breaking out in the following weeks keeps the US in a rather destabilized and divided position. Even though the current economic news seems to be covered in this report, the political scene in the US is in the epicenter at the moment, and developments relating to it, like the possible impeachment of US President Donald Trump, seem to keep the market on the edge. Moving now to gold's technical analysis and for our chart. In the latest sessions, gold has managed to break away from the 1840 support level, which was tested continuously. At some point, the price had dropped as low as to 1815 hurdle, but quickly bounced higher. Even though we could not underestimate the power of the bears after the price action in the past days, and our S3 1785 barrier is in place representing our lowest level noted. The recent surge higher may be a sign that gold traders have reached their limit and could be looking at higher grounds. For these reasons, we believe the R1 1875 could be the first target for traders, as the price action nearby that price was particularly relevant during the 25th to the 31st of December. Higher we have the R2 1900 hurdle as our round number line that traders could also be chasing. Finally, if gold's price moves towards the R3 1925 barrier, this could change the bearish outlook to a bullish one. The RSI indicator below our chart has also returned above the 30 level, implying the bears have given back some ground gained for now. That should sum it up for the week. We wish that you found this video interesting, and if so, please do not hesitate to share and subscribe. From all of us here at IronFX, best wishes for solid trading.